Welcome to the third chapter of this trading course where we're basically learning from the basics to the more advanced. It's giveaway time, and not only one giveaway, we are giving out 42 accounts of free Forex Tester Online accounts, so you can use Forex Tester Online completely free for everybody that enters the giveaway on this free trading course. And the conditions are really simple. Let's check them through. Basically, we need to subscribe to the channel and leave a comment under the video to enter. So basically there's 6 videos, so there's 6 entries that you can get. You could win a lifetime license basically for all your life, or basically or 1 year subscription or 1 month subscription. Each video is going to have 1 lifetime, 1 year subscription and 5 monthly subscriptions. So basically in total there's 42 giveaways that you can enter, and basically you can comment on every single video of this trading course, so it's excellent. Each video of this course will have its own giveaway, as I mentioned, and you need to comment under to basically have a chance. On top of that, if you comment with different comments, especially comments that features that you like Forex Tester Online or why you want Forex Tester Online, please comment down below. And basically if you have more than 1 comment, then you have more than 1 chance to win this giveaway. As well, really important, we need to register for a free account in Forex Tester Online. And to do this is really simple. Basically we only need to come down here where we can see our plans, and here we come to free demo, and we just need to enter with our Google account, Microsoft account, or just register with a normal email. And this is obviously is important so you can enter this giveaway. And last but not least, really important, you need to have an email on your YouTube profile. It can be any email, it doesn't need to be your personal email or anything like that, but preferably the email that you've actually used to register for this free demo, because this email is the one that we're going to use to be able to contact you. So to resume everything, what we need to do is basically subscribe to the channel, like the video, comment the video why you want Forex Tester Online, and register for this free account that I've just showed you at the moment. And this way you'll be entering in this giveaway. Obviously you can have all this information down in the description so you don't have any doubts at all. And we are going to finish this giveaway on September the 6th. And the draw time, basically we're going to do a massive live stream here on our channel on the September the 9th, where I'm going to announce all these winners. And like I said, really important, if you don't have a public email on your YouTube channel, we can't reach out to you. So please, if you are a winner, we have 7 days, or in this case you have 7 days to put your email on your YouTube profile as a contact method, so we can reach out to you and give you your free account. So good luck to everyone, and let's continue with the video. And today we are going to go into order executions, how to execute the orders, understand risk rewards and all this cool stuff. So let's go straight in. So right now we are in the euro against the dollar in the 1 hour time frame. We don't need to change time frames or assets or anything like this to understand this. We do need to understand that different assets have different lot sizes, but you're going to understand this right in a minute, because basically first thing we need to understand is that the price moves in pips. Okay, in pips, first in points and pips. So basically when we look at the actual numbers on this side here, we can see obviously it's got different values, and if we measure it, okay, we come here to the measure, we can see that this candle here has a size of 7 pips more or less. So basically 7 pips means 70 points. So as you can see here, if we look at the levels here, we'll be able to see it in points, and every 10 points is 1 pip. And once we understand the actual how the market moves in pips, then we can start understanding how we can open our positions, because obviously the size, the lot size, is basically the size that we enter the market, is going to depending on the pips that we're going to add as a stop loss. Basically, as you know, the stop loss is the level that you set to actually close a trade, and take profit is the level that you set to close the trade when you're actually winning. Okay, and the stop loss is obviously to avoid bigger losses. So most of the times what we're going to do is we're going to set the stop loss based on the size of our account. So if we have a $10,000 account, we're going to be looking probably at stop loss of $100. So this would be a 1% of our account. If we risk any higher, we have more odds to actually burn our account quite quickly. So obviously always when we start, I would always enter with a 0.5% of our account in case we're a live account. If we're in a prop challenge, this would be a bit different because there's different risk management that we'll be adding on there. We're always going to go with a low percentage of our account to start off, because obviously if we're starting, we don't want to lose money. And the best way to not lose money is first of all doing backtest, because if we do backtest, we'll be able to get used to the market, see how it works, see what works better for us, And then we can think about going to a demo account that we don't risk money either, because at the end of the day, it's not about who gets there first. It's about who gets alive. Okay, this is what trading is about. It's not a sprint, it's a marathon. So now we know this. Basically, we know how to measure in Forex. But basically, we're going to measure in pips, as you can see here. All this range here is a range of 25 pips. So based on this is how we can actually enter our order, because depending on the size of our stop loss, we're going to use one lot size or the other. And basically, the lot size is the amount that we enter the market with. So one lot basically is going to be $10 a pip. Okay, so if we have a 10 pip stop loss with one lot size, this is going to be $100. So this will be 1% of our account. And to set this is really simple. The only thing we need to do is open a new order, and here we can see lot size. So if I open one lot and I hit a stop loss basically of 10 pips, so this would be down there. Okay, we can see the 10 pips. Then we can see the 10 pips, 10.7. So this would be $107 of stop loss. Same happens with the take profit. If I set it at 10 pips, it's going to be sitting at $100. So this is really simple, but obviously we need to understand it so we can actually enter orders. And the thing is that if we maybe have a different type of stop loss on each trade, so in one trade we can have 10 pips and we have 25 or 30, that's where we need to calculate the lot size depending on the size in terms of pips. To always have, to basically always risk the same percentage, because it has no sense risking one trade, risking 1%, and the next one risking a 3%, and the next one risking a 0.5%, because this will fuck up your analytics and your equity curve. Because even if you've got the best strategy in the world, if you don't risk the same percent on each trade, it's probably going to be losing money when you could actually be making money. So now we know this, basically we need to think of what type of positions we have. We have the market position that is going to enter exactly where the price is at that moment, and then we have the limit orders that basically we can set a limit. So let's say I want to sell, okay, I want to add a sell when the price hits any place above here, so let's say at this level there, and then I can set my stop loss, take profit and everything, and when the price hits that level, then it's going to open a position. So instead of me being in front of the computer, it can open it just when it hits that level. And to understand the difference between the limit and the stop, the limit is always going to be, in this case, I can't put a limit down here because it's a sell limit, but the limit is always going to open a position against the actual market movement. So in this case, if the market pushes up, it's going to open the limit up here. Meanwhile, if it pushes down, okay, it's going to open the limit here, but the limit is always going to be against the movement. So if the price is coming down and it opens the limit, it's going to open a buy. If it comes up to this level up here, it's going to open a sell because it's going against. So the main difference of the stop levels is basically if I place a stop level up here and the price hits the level, it's going to open a buy, okay? And if it comes down below and it opens the stop, it's going to open a sell. So the stop is always going to go with the move of the market, like when it's opened the trade, and the limit is always going to go against. So if I want to buy a reversal trade, in this case, let's say I want to buy a trade on this zone here, I'm not going to use a stop, I'm going to use a buy, because basically I use a buy limit here, and there when the price gets to the level, it's going to buy inside, and then I'm going to try and get a higher level up here. Let's take my take profit. Meanwhile, if I want to use a breakout strategy, I'm going to use sell and stop positions, because basically I'm going to put my sell stop down here. Okay, if I had my sell stop here and the price approaches this level, then basically it's going to open a sell once it's broken out this level. And this is especially good in breakout strategy, because when the price breaks out, it tends to break out quite hard. And then we need to go into an even deeper part of this, and this is the risk reward. I'm sure you've seen it before, the RR or risk reward, call it like you want, but it's basically, what it's saying is how much do we risk and how much do we win. So if we use a risk reward of 1 to 1, this means I'm risking $100 to win $100. If I'm using a risk reward of 1 to 2, it means I'm risking $100 to make $200. And obviously 1 to 3, 1 to 4, 1 to 5, which is basically I'm risking $100 to win 300, 400 or 500. Then we have the negative risk reward, that is 0.5 to 1, meaning that I'm risking $100 to actually win $50. So I'm risking half. So depending on this is basically, it depends on the strategy that we're going to use, because some strategies work with a positive risk reward in terms of 1 to 1, 1 to 2, 1 to 3. Some work with negative risk rewards like 0.5 to 1, 0.7 to 1, 0.3 to 1. And all this will have a direct impact in our win rate, because if we have a risk reward of 1 to 2, we can expect a lower win rate than a 50%. More, if a 1 to 2, we probably expect a win rate of a 33%, 34, 35, 36. Meanwhile, if we have a negative risk reward of 0.3 to 1, saying I'm risking $100 to win $30, then my win rate is probably going to be sitting more at 75, 78, 80% win rate. Meanwhile, with a risk reward of 1 to 1, my base win rate was always going to be around 50%. Obviously, it depends on the strategy and how it works, but these are the actual basics. And to finish off, what we need to understand as well, obviously, is our leverage. Our leverage is basically the amount of money that we can put into each trade. So let's say if I have a leverage of 1 to 100, that means that for every dollar that I put in the market, the broker puts in $100 for me. And obviously this is great if we want to scale, but as well, it means that we need to be more careful, because we can burn our money easier. Because obviously I can enter the market with $100 stop loss in my $200 account, and I'm risking 50% of my account, and I can do this thanks to the leverage, as well as I can make $100 with my $200 account thanks to the leverage. So depending on the amount of leverage that we've got, we can enter with more lot size or less. But obviously isn't good or isn't bad. It's just basically something that we need to take care of. And if we calculate our stop loss always based on our percentage of our account, that's going to be no problem, because we're always going to be risking a 1 or 2 or 3% of our account. But if we don't, and we're not careful with it, we can burn our account in 2 seconds because of this leverage. So the leverage, basically, you'll be able to see it on the brokers. We have 1 to 500, 1 to 200, 1 to 100. And if we create a new project in Forex Tester Online, you'll be able to set it here, set up your leverage up to 1,000. Okay, the normal is 1 to 100. That's more or less the standard. Some have 1 to 200, 1 to 500. Depends on what you want to do in the markets, but normally 1 to 100 is a nice medium where we have enough space to open bigger lot sizes, because obviously we need to understand as well that we not always want to open a bigger lot size. Maybe we just want to have a really small stop loss, but obviously have $100 risked in that small stop loss, because we're going for a risk reward of 1 to 5 maybe. So obviously we need to have this clear, that it needs to adapt to our trading strategy. We can't use a trading strategy that normally has a stop loss of 1 pip and have a leverage of 130 and try and risk a 1% in a $10,000 account. That's not going to tend to work, because we don't have enough buying power. So basically, buying power is what the leverage gives us. So this is more or less all the basics of how to open a trade. And obviously, if you have any questions, I know it can be quite dense if you've never traded before, but it's all the basics that we actually need to learn before we even attempt creating a trading strategy. So if you have any doubts or anything like that, comment them back down below, because the next video is really interesting, because we are going to start with strategy development and how to create your own trading strategy. So stay tuned to that, and I'll see you in that one.